Welcome to Honest Money. On today's episode, Warren Ingram answers your questions around local versus international feeder funds for beginners, and is there merit in individual share investments versus index investing, and what would the growth rate look like? If you're enjoying the show, don't forget to subscribe and share.
Hi Warren, I hope that you are well. I have a question today on investing directly in a foreign currency denominated ETF such as the MSCI World versus the Rand denominated feeder ETF. So I'm a new investor who's looking to invest in ETFs, and a piece of advice that I received is that I should try to avoid feeder funds because they generally eat away your returns over time. However, from doing research on the various ETF options as well as reading several personal finance books, I've learned that generally it seems that investing directly in the say US denominated ETF is going to cost a bit more, and also there are some pretty complicated tax implications if you invest directly in an offshore ETF. So my question for you is, what is your take on that piece of advice? What would you advise for someone who's just about to start investing? Should one go into the master fund, into the feeder fund? And there are obviously benefits to both, but if one starts on, say, the Rand denominated feeder fund, at what point do you start considering when to switch over into, say, a US dollar denominated investment? Thank you so much. I really look forward to your insights. Cheers.
Thank you so much for your question. I think it's a very relevant one for a lot of investors who are starting out on their investment journey, and especially looking at the global markets and trying to find efficient ways to get their money invested for the long term. So the difference, just for people who are listening to this, between a feeder fund and a normal ETF is a feeder fund. You take your rands, you put them into an investment on the JSE. So you buy, for example, a world feeder fund. You put in money, whether it's $50 or $1,000 or 100,000 rand. And what happens is that money goes in, the ETF provider then takes that money, sends it overseas, and buys the underlying index. So in the world index example, they'll actually go and buy the world index on a global stock exchange. And then what happens with your investment is you get the benefit of whatever that stock exchange's index is doing around the world. So if the world index in dollar terms goes from $1 to $5, you get the benefit of that growth. In addition to that, you also get the movement of the Rand dollar over that time. So let's just say, for example, that you sent your money out at 14 Rand 50, and you bought the index when it was at that level. In 5 years' time, it's sitting at 19 Rand. Then that growth of 14 Rand 50 to 19 Rand, you would also get the benefit of that currency depreciation of the Rand against the dollar. However, if the Rand goes from 14.50 down to 10 Rand, then you would actually be losing, because then the Rand would have been stronger and you would be 4 Rand 50 worse off. So when you buy a feeder fund, just understand that you're getting the movement of the index as one part of your investment performance, and then the other part is the Rand versus the foreign exchange index that you're buying. So if you bought a Euro Stocks 50, which is the 50 biggest shares in Europe, then it would be the Rand Euro. If it was the Japanese index, the same. So it's important to understand those two dynamics. For me, I really like feeder funds when you're doing a debit order every month, or you're doing smaller investments, because you're not paying the bank to do the foreign exchange conversion for you. So you're not converting, your 5,000 rands worth of, or let's say your 5,000 rand into dollars, and paying a forex conversion fee to do that. And you're also not paying a transaction charge in dollars when you then have your dollars in a foreign stockbroking account, and you use that money to then buy a foreign ETF. Because often those transaction charges could be a fixed fee. So it could be, for example, they charge you $9 a transaction, or they charge you, a small percentage or something like that. So For debit orders and smaller investments, I like the feeder funds. I think they're a very efficient route. And so whoever was giving you advice that, don't use a feeder fund because it eats away your returns, I just think that's rubbish. They don't understand, or they've got a different angle for giving you that information. When do you convert your feeder fund into an actual dollar or pound or euro denominated investment? My view is that you probably want to do that when your investments are worth about 500,000 Rand or more. Then it's actually worth going through the pain of getting the foreign exchange, converting your rands into dollars, sending the money out, opening a foreign stockbroking account, and then buying the ETFs on the other side. When you invest in larger amounts, the transaction charges for the foreign exchange is usually better, certainly because it's a percentage. And then also when you're buying your ETFs via the stockbroker on the other side, especially if it's a fixed fee, then that transaction charge becomes a smaller percentage of the whole when you're trading in larger amounts. So I think that's probably the level that I would suggest. And for a lot of the time, I'd be happy to do it even at R1 million or more. I'm not sure that 500,000 is the maximum limit, but certainly the smallest limit before I would seriously consider it. Hope that helps, and thanks so much for your question.
Morning, Warren. It's Chris here. I'd like your opinion on South African blue chip companies compared to ETFs such as the S&P 500 or the MSCI. And what do you think the growth rate will be when you compare these to each other within the next 10 years?
Gee, Chris, I think it's a really interesting debate that you're about to spark with that question. Whether you buy, individual companies or whether you buy an ETF. The industry jargon for this is about active management versus passive management. In other words, do you try and choose companies that you think are going to grow faster than the stock exchange, or do you just buy the whole stock exchange and not worry about individual companies and just enjoy the ride up or down, depending on what goes on in markets? So history tells us that both in South Africa and in the rest of the world, that only 2 out of every 10 active managers, so those are fund managers that try and choose individual shares, can actually do better than the index. And for me, that's a bit like someone saying to you, you can start the year and not study, not do any learning, and you can pass the end of the year at school with an 80% pass mark by simply buying the index. So that's what I feel about index investing, is that you've got a very good chance of being in the top 20% of performers, being better than 8 out of 10 other individuals or fund managers who choose individual shares. And you can do it at a very low cost with very little effort or input from your side, and certainly hopefully less stress. So I think index investing for most of us, and I put myself in that category, is a very good way to go, especially if you're not a professional money manager or you're not someone who can commit a huge amount of time to researching companies and understanding them. And then I also think, having a special set of knowledge. So for example, if you're a tech specialist, in your day-to-day job, and you then decide to go and research tech shares, and you understand which tech shares are going to do incredibly well because you've got deep industry knowledge, then maybe choosing individual shares makes a lot of sense. But if you're like me and you don't know a lot about anything, then buying an index might well be the way to go. I will say, and before all the active managers get upset with me, that the 2 out of 10 active managers that do manage to beat the index often do it by a huge amount. So there is merit in looking at individual shares and hoping that you choose the ones that will do a lot better than the index. But I'm not convinced that I've got that skill. And for most private investors, I'm not sure that that'll be their highest chance of making money. So I think, Chris, if you're going to do it and you're going to choose individual shares, maybe do a blend. So you say, well, out of every 10,000 Rand that you're going to put into shares, 5,000 Rand you put into the all share index in South Africa, and then the other 5,000 Rand you choose a combination of different shares and hope that your share selections do well. If they do, then you'll benefit with half of your money and you'll still get the growth of the index. But if your share selections are not good, then at least half of your money will be in the index and will protect you against a complete loss of capital if things really go wrong. So short answer is choosing individual shares gives you the ability to generate more growth, but it does come with more risk. And so my preference is generally, small amounts of money, novice investors or people that don't want to put a lot of time and effort into this or worry about it, they should buy the index. Hope that helps. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.